Tech management spoke with Kritika Saxena, my colleague, and this is the interaction that they had.
When we started the year, we gave a guidance of 12 to 14%.
Correct.
Given that there's only one more quarter to go, we are guiding to be in the mid-range of the 12 to 14% guided range. So when we guided, we had excluded certain things, like Geometric was excluded. Subsequently, we acquired Butler, so that was also excluded from the guidance. We did 2 IP strategic partnerships. So one we are just announcing this time, and one we announced in the last quarter.
Correct.
So these 4 transactions were not included when we gave the 12 to 14% guided range. So now with these 4, we believe we will grow from another additional 0.6 to 1%, depending on when Geometric consummation happens.
Okay.
I hope that is clear.
That's clear then. So essentially, if you take that entire 1% contribution, you'll be able to grow FY17 14% in constant currency terms. Can I assume that?
Potentially.
Okay. In terms of the IBM IP deal that has been extended, you're investing, if I'm correct, 155 million additionally.
Right.
So based on the additional partnership that has been signed, how much contribution is coming into the guidance?
So it's a 155 million investment. It's a long-term contract. On an annual basis, we believe it will give us $45 to $50 million revenues. We're not specifically calling out what will happen in this quarter because the program is just started. So we are more confident of an annual number, which is $45 to $50 million from this round of IP partnership.
Okay, so altogether for Q4, what's the contribution that the entire partnership with IBM has, the earlier one and the extended one?
It's a little difficult to kind of break that down. So we've given all specific information. I think it's very easy for you to kind of deduct it.
Okay.
But I think overall 12 to 14% midpoint of the guidance and another potential 1% growth coming from all these 4 elements, depending on the timing of Geometric.
Okay, before we go into the margin bit, any more acquisitions, any more IP-led partnerships which can potentially drive the growth even further beyond a 14% mark that you could be looking at?
See, we are almost in the 1 month of the quarter is over, so I don't foresee anything which will have an impact on this year's numbers.
Okay.
But potentially we continue to look at opportunities. As a part of our Mode 3 strategy, products and IP partnerships is definitely a big focus area, and we will continue to do such deals.
Okay, let's talk about the margins. And margins have seen a significant growth. Analysts were expecting it to be almost 50 to 70 basis points lower than where you have come in. So take us through can you break up the margins based on the wage hike impact, given that the wage hike impact has been staggered and it will continue in Q4.
That's right.
So based on that, can you break up the margins for us?
Yeah, I would just give you the qualitative factors which helped us improve margins. I won't break it down into BPS. So we came in at 20.4, which is 30 basis points higher than the last quarter. And there are 2 significant drivers to improve margins. One is our dry ice autonomics framework, which is really delivering practical results on the ground. We had extensively deployed autonomics dry ice in our infrastructure engagements. In the last 6 months, we've extended it to our BPO and application services as well. So that's definitely showing some good positive impact. That's one. Second is, if you see that this quarter, our growth has been fairly good in all the horizontals. Like infrastructure has grown 2.1, application has grown 2%, which is highest in the last few quarters. Our engineering and R&D services has grown 7.1%. BPO, which was a little soft for a few quarters, that's also grown 2.9%. So there is a change in mix because all the service lines have grown. Because traditionally you will see slightly higher growth in infra and lower growth in other areas.
Correct.
So this change in mix is also driving an improvement in margins. Basically, these 2 broad factors helped us offset some wage hike impact and a little bit of utilization impact and give us a 30% benefit overall.
Okay. So last quarter, you suggested that margin should be within that 19.5 to 20.5% range. So by next quarter, would you maintain that range, or is there a possibility of inching margins higher, given that next quarter the wage hike impact will be lesser?
Yeah. So overall, our guidance was 19.5 to 20.5 for the full fiscal, and now the 3 quarters have gone, and we have done fairly well. We are we're really guiding the street on the next quarter, which is the current quarter, January, February, March. This quarter also we will be within the 19.5 and 20.5. So with that, you should be able to fairly estimate the range of the full year.
Okay, last quarter you had also said that the impact of wage hike on margins for Q4 will be 10 basis points. So
that's right.
Do you maintain that, or has that reduced?
Yeah, I think we said 70 basis points this quarter and 10 basis points next quarter. I think that's a defined number. It's not going to change.
Okay.
But of course, there will be other efficiencies and offsetting parameters which will come into play as well.
If you could specify, this time as well as last quarter, the financial services growth has been significant. Can you break up where you are seeing the growth coming in from in terms of processes and geographies?
Yeah, sure. Our financial services business tends to be, North America and Europe. These are the essential markets that we service in. And, we tend to focus on the large financial service institutions. So our model has always been that, focus on few firms, but try and have deep relationships with them. We have a client partner model which is working. So we try and see how we can do more services for the same company. Right? So that's essentially our model. So we like to add maybe a client or two every quarter, but we don't want to have many clients added. So that's the basic model that we follow. So because the model that we follow, our customers tend to be global. Okay? So most of our customers will have a US geography presence, Europe geography presence, and they'll also have an Asia geography presence. Okay? So therefore that's the model. So we see trends which are very similar between North America and Europe.
How much has digital contributed to this quarter? What's the growth been like? Some of the peers have started giving that differentiation.
We're not calling out on a quarter-to-quarter basis. I think in the analyst conference last year, we said on an annual basis, we will be providing some more granular details. So last year, we said digital contributes to 20% of our application services revenue. So I think it's more or less in the similar range, and we will give you a more accurate number when we finish the year.
Talking about US, are you worried? Is there caution as far as the US market is concerned?
If you look at our portfolio, we have the lowest dependence on H-1B visa.
Correct, yeah.
And,
that's 50% right now as far as your on-site.
Yeah, but the number of applications that we apply for is very small, right? We only look for very specialized skills, and that's where we apply for H-1Bs. And we adopted the global delivery model at least 7 years back, where we started creating global delivery centers. We have 6 large delivery centers in the US where we hire local people and deploy them on our client projects. Now, and that's one reason why our dependence on visas had come down over a period of time. Now we are continuing to strengthen that strategy, and I'm sure that will de-risk us from any potential restrictive regulations which may come up.
Gartner has cut its full year guidance by about 1 to 1.5%, which in the long term is still heavy. What are clients telling you in terms of budgets?
See, if I look at our client landscape, most of them, their budgets are at best flat or a little bit increasing. I mean, that's the reality, right? While Gartner has a much broader landscape, if I were to look at the spend of our clients, I would say between FY16 and FY17, it would be more or less the same. If I take your top 50 clients, I think it'll be broadly the same.
Will FY17 be marginally better than FY16, given the fact that FY16 was a tough year for the industry?
I think we bucked the trend in FY16 and our fiscal FY17. So let's finish the year, and when we meet next time, we'll probably give you a much better, sharper commentary on FY18.
Okay, that is the HCL Tech